The IPO rush across the country is driving retail as well as individual investors to the subscription door. While the rush, however manic, augurs well for the economy, one needs to be circumspect in the picks. Most of the IPOs in recent times have been of companies barely making even in their yearly earnings. With Paytm's share allotted on Monday and the company yet to have a proper roadmap towards profitability, it's a double-edged sword for the investors. Thus, think twice, not twice, before you take the plunge in the oasis that is the Indian IPO story. Hi and welcome. You're watching TFI English, the national and socio-political analysis arm of the TFI Media Group. I am your host Isha, and in this video I will tell you why you should think thrice before you take the plunge in the oasis that is the Indian IPO story. Let's begin. The historic bull run of the premier stock indices of the country, aided by the dizzying IPO valuations, has earmarked a tectonic shift in the economic success story of the country. There is a carnival of sorts across the country, but even a layman is pondering of investing in IPOs, a feat which would have been deemed rather unthinkable a few years ago. While companies going public one after another augurs well for the economy of the country, it needs to be taken with a pinch of salt given the shaky numbers of the companies taking the plunge. Reportedly, Indian beauty startup Nykaa that got listed on the stock market last week with the market capitalization crossing Rs 1 lakh crore has sprung up a surprise. The IPO investors had massive listing gains as the shares opened at Rs 2018 on the NSE with a jump of 79% from its issue price of Rs 1125 per share. However, today, the share price took a severe beating as it was revealed that the company's profit fell 96% as marketing costs surged in the quarter preceding its IPO launch. According to news reports, Nykaa's net income dipped to Rs 1.2 crore in the quarter ended September from Rs 27 crore the previous year as a 92% increase in expenses dropped the 47% gain in revenues. While Nykaa's results of last quarter were not published until after the listing, the investors gung-ho about the profitability of the company subscribed to the IPO by over 100% on the first day of the offering itself. Compare that to Paytm, formerly known as 197 Communications, and one can apprehend the differences in enthusiasm. At Rs 18,300 crore, Paytm had the biggest IPO ever in the country after Coal India in 2010. However, unlike Nykaa, the Vijay Shekhar Sharma-led company crawled to a full subscription before its close. The slow subscription suggested that retail investors were wary of the overinflated numbers. Institutional investors bid only for 2.79 times the shares reserved for them, while retail investors subscribed only 1.66 times the shares on offer. Moreover, Jack Ma's Ant Group selling its stakes in the company further sent the alarm bells ringing. It is pertinent to note that Paytm competes in an oversaturated market where it is no longer the leader. PhonePe and Google Pay together had an 80% share of the UPI transactions in September 2021. PhonePe had the greatest number of UPI transactions in September 2021, followed by Google Pay and Paytm. Moreover, in its 11th year of operation, the company is still a loss-making company. In financial year 21, when the use of digital wallets and mobile payments surged, the company posted a decline in revenues. Despite a 60% cut in marketing and promotional expenses, the losses continued and the road to profitability is unclear. There is no denying the fact that despite being a loss-making company, with no hopes of breaking even in the coming years, Paytm might have a bumper listing much like Zomato, which defied common sense as well. As reported by TFI, Zomato rode the hype train with inflated valuations and managed to bag a lucrative IPO listing. However, even today, observing the food aggregator's number leading up to the IPO makes one wonder how the Indian market operates, or is it just a big bubble waiting to burst? At the time of the IPO issue, Zomato was pegged at Rs 66,000 crore or $8.8 billion in valuation. However, a year ago, when the pandemic had not struck the world, the food major's valuation was $3.5 billion, and that too after acquiring Uber Eats and its Indian services. What appeared rather quizzical was the fact that in a pandemic year, when Zomato's average delivery order value fell from Rs 400 odd to Rs 238, the company managed to scale its valuation manifolds. Make no mistake, the company is still making a handful of money to its investors. From the issue price of Rs 76 per share, the company has risen to Rs 161 per share as of the last recorded trading session. Understanding IPO is simple. There are two ways through which any company generates capital for any of the myriad purposes. Most companies need capital to expand their operations, some require it to infuse vertical growth, while some require it to wipe the slate clean and fend off the debt. The first option to raise capital is to head towards the banks and ask for the loan or turn towards venture capitalists, which is a rather risky proposition. The second way is by offering shares of the company to the public and making sure that debt loads are reduced, liquidity is achieved, and hopefully the visibility of going public helps achieve the desired goals. Using the last option has become a recent fad in the Indian market. Even the government has hopped on the bandwagon and is coming up with the biggest IPO the company has ever seen. The government is planning to sell up to 10% of the Life Insurance Corporation of India to raise up to Rs 900 billion. Meanwhile, another Indian unicorn, SoftBank, banked Indian hotel aggregator Oyo Hotels, envious of the success of Nykaa and Zomato, is mulling rolling out the IPO. It is pertinent to note that Oyo's net losses stood at Rs 33.82 billion for the year ended March 2021, and yet there is a palpable excitement surrounding it. TFI is not being a negative Nancy and understands that the Indian market defies expectations. A year ago, if someone would prophesize that Sensex would be breaching new records every day, the majority of us would have scoffed at the proposition. However, here we are, and Sensex is one of the best performing indexes on the global map. As Rakesh Jhunjhunwala, the big bull of D Street, remarked, "We are just at the threshold of what I think is going to be one of the largest bull runs in India ever. India is changing and many people are investing in the change. Thus, it makes sense to take the leap of faith. However, the investor should not be on a spree to invest in every single IPO. Reading the numbers and anticipating future movements is necessary while making the decision. As for the country, we sure do hope that the deluge of unicorns we have seen this year soon get to the podium and launch their IPOs as well. India is finally realizing the power of its stock market."